Enzio Von Pteil, who's independent strategist and macroeconomist, joins us from Hong Kong. Enzio, thanks very much for speaking with us. What are the chances of major central banks taking coordinated action to support the weak world economy at this point?
I think those chances are very high indeed. We have the ECB meeting shortly. We have the US Central Bank meeting on the 1st of August. I'm of the view that the industrialized economies, central banks, those of the US, EU and Japan, will be easing. Not that it's going to help a lot, but that will at least improve market sentiment in the short term.
How would Europe's simmering debt issue continue to impact Asia?
Really, the key mechanism has to be via the exchange rate. We, of course, in Asia have what I would call the dollar block, the renminbi, the Hong Kong dollar, and indeed even the Singapore dollar, because it has a major weighting of the dollars in its currency basket, and then that non-dollar block. Now, the dollar, I believe, will continue strengthening against the euro on a trend basis. We're looking at the euro reaching 115 on a 6-month view, and that then would suggest that Asia's exports of this dollar bloc, particularly China, but also Hong Kong and Singapore, to Europe will be thwarted somewhat by the stronger dollar against the euro. Meanwhile, the relative winners on the export side will, of course, be Asia's non-dollar currencies, particularly the Indian rupee, the Korean won. These currencies have, of course, these exchange rates have fallen quite considerably against the dollar and thus against the euro for the past months. That will continue. The other point, though, to mention is on the import side, because the strong dollar economies of Asia, China, Hong Kong, Singapore, will be importing more and more European luxury goods, and that will lead to more retail tourism in Hong Kong, Singapore, and China. That in turn would favor quoted luxury goods and quoted luxury hotels in the dollar bloc economies.
What are expectations for the inflation, GDP and the trade data out from China next week?
Inflation rising, but because of rising cost push pressures, what we have always felt is that the food price increases are something that the central bank simply cannot control because it cannot control the weather, as we all know. But a food price increase is, of course, bad because it's a form of a tax on the little man's wallet. On GDP, I expect the second quarter GDP to come in at about 7.2%. I'm of the view that the GDP will continue slowing till about the fourth quarter of this year, by the time the government starts getting its own stimulus measures, its selective stimulus measures going. On the trade front, what we just suggested, being a strong currency economy, I think that China's exports, particularly to Europe, but also to the US, will be suffering somewhat at the expense of India's and Korea's and Taiwan's exports to America and to the US and to Europe.
Right. Turning to India, what's your macro view on the country and where does it stand among Asian emerging markets in terms of attractiveness to investors?
Along with everybody else, I think India's economic time is quite paltry. It has an excess demand for money. The central bank hasn't really eased enough. It has a clear excess supply of goods. The industrial production keeps slowing. My view would be quite bearish for other factors, namely the corruption in India that has recently come to light yet again. The elections coming next year, I believe, that will lead to a stalemate in policy making. And finally, just government ineptitude. I'm afraid that the foreign investor in particular is getting a little bit leery of this constant zigzagging of government policies. So I think that those are three factors that are driving the rupee down, that are driving Indian money that should be going to India, are keeping it out of India because of these three factors, and that's driving the rupee down. So even if the stock market were to improve, which I don't think, the rupee will eat up those gains by continuing to fall.
Okay, India needs foreign investment, and one spanner in works is the GAR, the General Anti-Avoidance Rule, targeting tax-evading companies. But the vagueness of the implementation is a concern, especially to foreign investors. How do you expect the outcome to impact foreign investment?
Much the sameness of what we're seeing now. They have already apparently flip-flopped quite a bit. It was introduced in March, I believe. By May, some hoo-ha had already been created around it. Now the Prime Minister, who's also doubling up as the Finance Minister, Mr. Singh, wants to introduce new measures shortly, but again, it's the implementation that is so unbelievably difficult in India. I think that that's where China has a clear edge, because as unpalatable as it is, at least it's a dictatorship, things can be dictated from above, whilst India is, of course, a very slow-moving democracy. So it's the implementation that's going to keep the foreign investors out, because, frankly, there are more interesting alternatives, even in Asia, for them to put their money with.